From New York City for viewers worldwide, I'm Scarlett Fu. The new one-hour edition of Bloomberg Real Yield starts right now. Coming up, traders adding to rate cut bets on the heels of weaker than expected jobs data. We'll be getting insight from Oksana Aronov of JPMorgan Asset Management and Jeff Sherman of Doubleline Capital. And a sell-off in software debt pushes billions of dollars of loans into distressed territory. We begin with the big issue, the health of the U.S. economy.
We haven't yet really seen a tension between what the Fed, I think, would like to do, which is bring rates down, and the underlying data yet.
This loosening labor market should also give us confidence that inflation will come down.
As inflation starts to get low, I think the Fed's telling you they might cut.
We're thinking inflation is moderating more than the markets think.
I think you're going to see a steepening of this yield curve.
Rising U.S. yields on the back of rising U.S. growth, it's not the end of the world.
There's still some risk there that investors should kind of fade on the long side of the curve.
There's so many holes in the data that haven't been addressed.
There's a lot of difficulty in reading, I think, the trends. In productivity cycles, you don't have inflation problems at the same time the growth is strong.
This tug of war between inflation and labor, it feels like the labor market will win out.
It always comes back to jobs.
Here's our chart of the week, which shows the restoration of the inverse relationship between the prices of stocks and bonds. So the weak jobs data pushed the two-year yield, which is in blue, toward the lower end of its range. And you can see stock futures in white basically followed that path. While markets may be bracing for a slowing labor market, that may prove to be a blessing to Kevin Warsh, the Fed chair nominee, because if data continue to deteriorate, Warsh, who is considered a rates dove and balance sheet hawk, can cut rates with fewer questions. And if yields do come down due to haven demand, the market will be better positioned to absorb an unwind of the balance sheet if it comes to that. Now, sticking with the data, BlackRock's Rick Rieder doesn't see any ambiguity in the labor market.
Look at what we got yesterday. Look at the JOLTS report. Look at the Challenger job cuts. You look at the claims data. You look at the ISM services in terms of jobs. There's no ambiguity around where we are in the jobs market. We're having a really tough time. We're watching productivity explode higher in terms of growth being really good, but a job market that's really tricky.
Let's dig into all of this with our macro roundtable. I'm pleased to welcome Oksana Aronov. She is head of market strategy, alternative fixed income at JPMorgan Asset Management, and Jeff Sherman, deputy CIO at Doubleline Capital. Oksana, let me start with you. Treasuries resumed their role as a traditional haven, helped by the latest Challenger data and jobless claims showing weakness in the labor market. The 2s, 10s curve steepened to the widest in more than 4 years. Is there more curve steepening to go?
So this is a really interesting and important point that you're bringing up, which is that treasuries or traditional interest rate driven fixed income risk is really only going to be that hedge in the event of a recession. And the deeper that recession, the more of a hedge it's going to be in the absence of an inflationary, simultaneous impetus or a stagflationary scenario, which is, not on the table, I guess, currently to a large degree. In any other scenario, treasuries are really going to struggle to be a hedge, and we've seen many days where you see the weakness in equities and you see a corresponding weakness in treasuries. And so I think investors are increasingly kind of trying to figure out how do they hedge risk. If recession is not your base case, which certainly a recessionary scenario is a very small probability right now, and the general expectation, we agree with this, is that the economy in the U.S. will continue to show resilience. Then that duration or interest rate risk probability will continue to be a very volatile one, which is what we continue to see.
Jeff, what do you think?
Yeah, I mean, look, what we've seen in the Treasury market is the front end of the curve probably out to like 5s. And yes, we saw yesterday kind of the back end do a little bit better. But that's been the part of the market that's been more this kind of economically sensitive. The back end of the curve, though, we're still kind of closer to the cycle highs than kind of at the low end of the range like we're talking about those other parts of the curve. So when one's talking about the positioning in the Treasury market, I think you still have to be very cautious of that back end, let's say the long bond, for instance. And we've seen the uncertainty there, whether that's the, just the uncertainty that comes out of Washington, whether it's the uncertainty about policies, And just are these policies somewhat inflationary? And cutting rates too early could also lead to that as well. So the curve steepening, we still like that trade. We still have that trade on in our portfolios. And we think, betting on a steeper yield curve is probably easier money to be made than essentially calling the direction of these interest rates over the very short-term time frame right now.
Oksana, after cutting rates 3 times last year, the Fed is basically on pause, we think, until the middle of the year. What did that cutting cycle actually accomplish? What did it do? What kind of effects has it had on the economy, on addressing specific issues like affordability?
Well, that's really the key, right? That's the issue that this administration is very focused on, affordability. And if you look at this policy through the affordability lens, it has not been effective because whether it's mortgages, whether it's the actual 10-year Treasury yield, mortgages or other, small business loans that price off of it, everything is actually, both the 10-year and the cost of mortgage is actually higher today than it was when the Fed started that cutting cycle. You've seen long-term rates move up. And why is that? Because the long-term, the long yield part of the curve, the 10-year particularly, doesn't care about Fed funds policy anymore. What is it reacting to? It's reacting to fiscal policy. It's reacting to inflation uncertainty. It's reacting to the tremendous amount of Treasury supply and the foreign demand that at the margin creates the appropriate technicals to take down that supply or not. And that's really what's driving the 10-year, much more so than what the Fed funds policy is at the front end of the curve. And that's really going to be, Kevin Warsh's challenge if he ends up sitting in that seat, particularly combined with his, of course, views on the fact that the Fed should have a smaller footprint on the economy via its balance sheet and on the markets. And we'll see how he balances or walks that tightrope.
Jeff, there's a ton of cash on the sidelines, $7 trillion stash in these money market accounts. And it doesn't appear that the lowering of rates since, the rate hike cycle has really moved much of that money, a meaningful amount of that money out. Why is that?
Well, I'm going to reference the name of your show here, Scarlett. It's real yield, right? Still, even if you're in T-bills, they're generating a rate of yield that's above the level of inflation. And so, if people are looking just to kind of preserve purchasing power, that's the cash side does that. Stepping out the curve a little bit, if you run something in the 1 to 3 year part of the curve, you can probably pick up 50 to 75 basis points in a good quality, diversified portfolio. And as you step out, as Oksana said, there's been more volatility in that curve, and I think investors have been a little skittish to step out there. And so, as she also said, unless your base case is really that we're having a meaningful slowdown and it's more recessionary, it's hard to really argue that rates should go meaningfully lower simply on the supply issues. It's also the inflation uncertainty, as she said. But as you think about kind of just the overall marketplace today, what you have is just this affordability is first and foremost at the top of mind of the administration. But none of these policies are going to help affordability when it comes to the housing market. We have a supply problem there, and lowering mortgage rates, even if you lower them 100, 150 basis points, it doesn't solve the affordability crisis. The affordability crisis comes down to price. And so I think when you start to look at the behavior of what the administration's talking about, what the Treasury Secretary is talking about, they're trying to talk this market down. Yeah. But the bond market's bigger than all of them. And that's the challenge you have. And I think investors are a bit skittish to that.
All right, stick with us. Oksana Aronov of JPMorgan and Jeff Sherman of Doubleline, because coming up, we're going to step into charted territory and hear from Atlanta Fed President Raphael Bostic. This is Real Yield on Bloomberg. I'm Scarlett Fu, and this is Bloomberg Real Yield. Let's step into charted territory. Each week, we'll be speaking with Bloomberg International Economics and Policy correspondent Mike McKee about his favorite chart of the week. He joins us from Atlanta today. But before we get to the chart, Mike, let's listen to a bit of your conversation today with the Atlanta Fed President Raphael Bostic.
I was not at the Fed when the decision was made to go from the scarce reserves to an abundant reserves regime. I do know there were tensions and a lot of volatility that happened in the scarce reserve environment. And so if you were going to move back to that, I would hope that there'd be a discussion about how to mitigate that volatility.
All right, Mike joins us now from Atlanta. So this was kind of like an exit interview for him.
It is kind of an exit interview for him, and it's one of the big issues, the scarce reserves policy, that Kevin Warsh, the new Fed chair designate, is very high on. He'd like to shrink the balance sheet, get rid of QE, and basically go back to the way the Fed did monetary policy before 2008. Now, Bostic says it would be difficult, but you could do it. His question is, why would you want to? And what we know is that the markets don't necessarily want that to happen. I've got a chart for you here that shows what happened back in 2019, and anybody who was on a money market desk then remembers it. We had a massive spike in money market rates, Treasury General collateral, when the Fed, reducing its balance sheet, got too far down, and there weren't enough reserves to go around. And you can see that immediately after that, the Fed started adding reserves again, and we saw rates calm down. But nobody wants to go back and have that happen again.
Right. And of course, this is a snapshot of 2018 to 2019, so it doesn't include the pandemic when the Fed expanded its balance sheet to almost $9 trillion. Jeff, let me bring you into this conversation. Can we rewind the clock back to 2008 when it comes to the Fed's balance sheet?
You can, but the bond market's gonna probably sell off. I mean, you've got to absorb the supply, and so you talked about not showing the pandemic levels. I mean, we've expanded the amount of Treasury issuance by like $7 trillion, $8 trillion over that period, and we're running deficits north of $2 trillion a year right now. And so if you don't have this other area to absorb some of that, it's got to be absorbed by the market participants. And so you have to find a buyer. And given what we've seen is some reticence of foreign buyers out there, you'd have to relax some regulatory relief to the banks or force them to buy treasuries. You need to absorb that supply. So although it sounds great in theory, I think if so, we're going to get higher rates, at least the belly to the back in the curve, under that guise.
And that's not what the president wants, and it's not what Kevin Warsh wants. Oksana, what is the damage from keeping the Fed's balance sheet at current levels?
Well, I think it sort of compromises, when the yield curve was inverted for a number of months and even years, and people are saying, oh, it's pricing in recession, it's one of the best indicators. And I kept saying, I question the forecastability of the curve when there's $7 to $9 trillion of bonds sitting on the Fed's balance sheet. I don't think the curve has any forecast ability, because if that was not the case, then of course we would have higher yields generally. So that's really the challenge. And it sounds like the right thing to do, because the markets should be able to stand on its own feet and should be able to stand on the underlying fundamentals of the things that are being bought and sold, and not this implicit Fed put. And so if the Fed put is going to be viewed as, not implicit, not necessarily there for you, yes, there's going to be a repricing based on that.
Mike McKee, what is Kevin Warsh's ideal scenario?
Well, his ideal scenario is we go back to what they called the corridor system, where the Fed sets a target rate and then banks let the Fed know what the demand for reserves is. And they would do open market operations every day or a couple of times a day to try to keep it in that range. His view is that banks should lend to each other and the government should be out of that business. But one other problem that has come up, of course, is that in the years since they started the floor system that they use now, you've created a whole industry, the repo industry, that is built on the idea of having reserves available to trade and to borrow from the Fed that can then be rehypothecated to somebody else. So getting out of that is going to be very difficult, as well as the problems that everybody else was mentioning here.
So it gets technical really quickly here, Jeff. What can Kevin Warsh do when he first arrives at the Fed to address this, if anything?
I think it's going to be difficult. Kevin Warsh is just one man. And remember, you've got to get this consensus built throughout the Fed. And so, it's kind of strange that historically he's been so hawkish, whether that's on inflationary policy, also on the balance sheet. And, he's talking about potentially lowering rates, which, those things just don't circle, except that obviously the administration is putting the pressure on him. And that was the sole criterion for getting the job. So I just don't know what he can really do at this point. They can talk about it. They can try to do it. But remember, everybody's on Chairman Powell about reducing the QT program. So we've shut it off for now. So there was the balance sheet unwind. And I think in order to do that, they've got to find another buyer. And just to me, I just don't see how that plays out in the next, in just, kind of the near term, let's call it the rest of 2026.
How do you see this playing out, Oksana?
Well, there's the additional challenge because, we mentioned foreign buyers being a very important component in this equation, with China and Japan vying for first place in terms of who absorbs the most U.S. Treasuries. And Japan, of course, just went through a historic surge in yield. And the question of whether some of their money will want to be repatriated into their domestic yields, because they are now more attractive. And what does that mean at the margin for demand for U.S. Treasuries? So it is a complicated situation all around. And I don't think it's one that anyone can really do much about without causing a disruption to the markets in the absence. And you mentioned earlier in the show, if rates move down because of a slowdown in the economy, would that well, that will create its own issues, because then you may have to actually grow the balance sheet, as unbelievable as that sounds.
Pretty incredible here. So, Jeff, in terms of you saying that Kevin Warsh will just be one member of the FOMC, I'm curious to get your take as well on whether Jay Powell stays on in any capacity past his term ending as a member, as the chairman of the Fed. Of course, he has that seat on the Federal Reserve Board.
Yeah, no, we'll see. I mean, historically, that's not been the case. I mean, if anything, maybe there's a higher probability now because of the investigation and the charges brought against the Fed. Maybe that caused them to want to fight a little bit longer. But why fight at this point? I mean, you've been doing this for over 9 years. You have a pretty decent track record. Yes, you missed the transitory inflation, but why not just go out on the high horse, and just take the typical road. So. What he would gain or prove by doing that, by just sticking around. But one thing on Oksana's comments as well is that if we're cutting rates and we're bringing these rates down, and we get convergence of yields globally, that actually makes treasuries way less attractive for the rest of the world as well. So all these things come together. And so, again, back to Powell, I'm just not sure why he'd want to be around in this. He's done his job. He's done his public duty. And I think he would just like to ride off in the sunset and quick and attacked.
Well, with rates converging around the world, how much do Kevin Warsh's comments, when he does start to make them, whenever that is, really reverberate for investors in Japan, in the UK, who are looking at perhaps more attractive yields elsewhere?
Well, look, the U.S. is going to continue to be a significant point of convergence for wealth created globally, because there's just not enough stores of value. I mean, you're seeing gold go through the roof, right? It's all part of that same desire to find stores of wealth. And at the margin, we're seeing players diversify their exposure to the dollar for all the reasons that, all the comments that this administration has made, and they're focused on a weaker dollar, et cetera. But still, to a large degree, there is no market deep enough, big enough that can absorb that, global wealth creation. And so the Treasury and the dollar are going to continue to benefit from that for, the foreseeable future. But certainly at the margin, every asset allocator out there is thinking about, how do I diversify my dollar exposure? And that has very meaningful ramifications for where, what is the cost of our debt is at the end of the day. Where is that 10-year going to be? I mean, notice with all of this hand-wringing around labor market weakness, which, by the way, we still don't know what is the appropriate amount of jobs created in an economy that no longer has the kind of population growth that we had a couple of years ago, right? But for all the hand-wringing around the labor market, we're still not really seeing a meaningful rally at the long end of the curve. It's staying there because, again, the technicals are not supportive. The supply is tremendous, and the demand is there, but is not enough to really tamper down that cost significantly.
So, Mike, I'm curious, with this Sell America trade that we're kind of referencing here, or at least diversifying away from U.S. assets, is this something that the Fed thinks about? Is this something that Raphael Bostic has thought about, or, is mindful of as he responds to questions about how the Fed moves forward?
Well, with the caveat, Scarlett, that anytime you mention the word dollar to a Fed official, they say, not our job, call Treasury. They, of course, do think about it because their job is to worry about the U.S. economy and what the impacts would be of something like that on the U.S. economy. But their basic view is that the dollar is strong enough, even if there is some aversion to buying it right now, that it isn't really going to change the dynamics of interest rates all that much to move the way it does. And so it's not going to really affect monetary policy. They'll keep an eye on it, but until somebody comes up with a better idea for a global currency currency for the reserve currency of the world, it isn't going to be a major problem.
Well, they tried with Bitcoin. I'm not sure it's working right now. Oksana Aronov of JPMorgan, thank you. And Jeff Sherman of Doubleline Capital, and our very own Mike McKee joining us from Atlanta. Really appreciate having you all on. Coming up next on Bloomberg Real Yield, the shares of home builders like Lennar falling on a headline from the White House and possible antitrust probes regarding these builders. We've got details next. This is Bloomberg.
Happy Friday. I'm Norma Melinda. Let's take a look at your Midday Movers. The Trump administration officials are discussing options for launching an antitrust investigation into U.S. homebuilders as part of the White House's effort to tackle the housing affordability crisis. According to people familiar with the discussions, the White House is considering directing the Department of Justice to open a probe into the industry. Shares of Lennar and D.R. Horton are both falling. Speaking of housing, Zillow shares are rising for their best day since November after a judge ruled in favor of the digital real estate site in its legal battle with industry competitor Compass. The ruling allows Zillow to continue to block certain listings while the antitrust filed by Compass proceeds. This acts as a major blow for Compass, which has sought to build a private listings network. Amazon shares tumbled for their biggest drop since 2024 after the company announced plans to spend $200 billion this year on data centers, chips, and other equipment. The company says the spending will mostly go toward the company's AWS cloud unit, and most of that spending will be for AI workloads. Meanwhile, Stellantis is pledging for its worst day ever. The automaker is taking more than $26 billion in charges, mostly connected to its decision to peel away from the EV market. The stock's lost nearly half of its value since its February 2025 high. The company's CEO blamed his predecessor for going all in on EVs, saying this move, quote unquote, largely reflects the cost of overestimating the pace of the energy transition. Elsewhere, software stocks are rebounding today after an 8-day slump sent the group on pace for their worst week since 2008. An ETF that tracks the group has lost more than as much as 12% over the past 5 days. App11 and Unity Software are among some of the names higher in today's trade. Those are your Midday Movers. I'm Norma Melinda.
I'm Scarlett Fu, and this is the new one-hour edition of Bloomberg Real Yield, where we wrap up this week's action in rates, risk, and the cost of capital. It's time now for the auction block, where we highlight the big credit issuance of the week, starting with U.S. investment grade. Weekly volume was the second busiest of 2026, coming in above $60 billion. The big headliner, of course, Oracle, followed by Bank of America and UBS. Looking closer at that massive $25 billion Oracle sale, investors placed orders of more than $129 billion, edging out the prior record of $125 billion for a Meta bond sale. Oracle last tapped the market back in September, raising $18 billion in one of the biggest offerings of 2025. Demand was also strong in high yield, especially for a sale from a unit of crypto firm Cipher Mining. It logged one of the market's biggest order books in years. Black Pearl Compute attracted $13 billion of orders for its $2 billion sale. It's connected to a data center in Texas that will be leased to Amazon Web Services. Now, sticking with credit, Ares Management is dismissing this market narrative of AI disruption to software.
The narrative is wrong in many respects. It's not to say that people shouldn't be focused on AI, but you have to be thinking about opportunity and risk. I don't think it's as binary as the way that the market is interpreting it. A lot of this private market discussion, I think, is missing the very simple point that these loans are largely senior secured loans. Now, people have different exposures to different types of companies. Senior secured loans, 30% loan to value in very mature enterprise software businesses with 75% or so of the capital structure owned by institutional equity or corporates. So I think the first thing that people just aren't understanding is how senior and safe a lot of these companies are.
All right, let's dig into all of this with our credit roundtable. I'm pleased to welcome Danielle Poli, Assistant Portfolio Manager for Global Credit Strategy at Oaktree Capital Management, and Andrzej Skiba. He is head of BlueBay U.S. Fixed Income at RBC Global Asset Management. So we know that the stock market this week really freaked out over software companies being eventually displaced by AI, while credit markets as a whole, you could say, seemed less panicked. Danielle, within the credit space, where did you see stress showing up, and to what extent did those concerns really intensify this week?
Thanks for having me, Scarlett. It has been quite a week. We did see some stress in the market related to software companies, more pronounced in the equity markets than credit. I think speaking to credit being a way to diversify portfolios in this type of a market, what we found is that there wasn't a lot of differentiation between businesses that genuinely could be impaired by AI and those that may remain durable. And so we have seen a snapback in the market today. In these types of situations, we're looking at both risks and opportunities. The high yield market was more immune than loans, given its lower concentration to the software center. But in multi-asset portfolios that are diversified across a number of different areas, the reaction was much more muted.
Andrzej, we definitely see it in loans. You see it in some BDCs, some private credit as well. How much of this anxiety in software is contained? How much does it spread?
Well, we think it might be just the beginning of the move, because the market will struggle to determine how much of a danger these sectors are in, and we will not have much data over the coming weeks or maybe even months to validate fears one way or another. So as far as we're concerned, this can have a broader impact on our asset class going forward. And I bet you there are a lot of investors, particularly within the leveraged loan markets, that are looking to diversify away from the software space to find other sectors that are less impacted by the AI narrative and try to find a safe haven there. When it comes to investment grade markets, it's less of a drama because the size of the market, the liquidity of our markets are far greater. But even there, we're seeing quite a pickup in volatility.
Andrzej, do you start to question the entire tech sector, reprice risk overall?
I wouldn't say that this is the narrative that we believe in. However, we are worried about vulnerability to a lot of software issuers to AI disruption. And the biggest problem there is the level of leverage, how much debt those companies are saddled with. When merger acquisition transactions happened, all these were valued at very high multiples because investors were believing in long-term repeatable prospects of these companies. If you change that narrative, market will demand a lower multiple, and that can spiral across the space. So this is, to us, the biggest level of vulnerability that we see right now.
So Danielle, let's just say that that happens. The concern spreads, and it goes much wider than software. It starts looking potentially like a contagion. Does this set us up for a big refi problem?
I don't see a widespread contagion event right now, just given how resilient a lot of fundamentals of companies are in today's market. So let me caveat that first. But if we do see broader contagion, spreads widening, it does create a more challenging environment for repricings. But what I would say is there's still too much money out there chasing too few deals. This is a competitive market. There's a lot of money on the sideline that's ready to go in terms of rescue financing and capital solutions for these types of companies. So I don't think there'll be a dearth of capital out there for companies looking for financing in this type of a market. It, again, just speaks to the point Andrzej made about really needing to go through and understand the impact or potential impact AI could have on some of these business models, and making the differentiation around which one of these companies are going to be durable for the long run. So having a bottom-up fundamental approach,
right,
I think is key in this type of a market.
Yeah, doing the due diligence, doing the work. She mentioned how there's a lot of money out there still chasing things, but we also know, Andrzej, that there's a lot of need for funding from these hyperscalers. Amazon's capex will reach $200 billion this year. Alphabet is looking to spend as much as $185 billion this year. That's a lot of supply that's coming to market to fund this AI build-out. Are investors getting paid sufficiently to take on these risks?
Well, clearly judging by the price action we've seen in the markets on the back of these huge capex announcements, and that reaction was widening in spreads, clearly the market is sending the message that no, that we need more compensation to absorb hundreds of billions more in issuance than the market might have expected previously. So we absolutely believe that unless you have an influx of new money into the asset class that helps to balance the books between burgeoning supply and demand, you will need to see spreads moving wider. And we're not saying that that's impossible. There are two key sources where you can see that demand coming from. The first one being from money markets.
That's $7 trillion worth of money, right?
Exactly. The curves are steep, so it actually makes sense for some of the 7 trillion balances moving towards credit. And the other space is in agency mortgages. Every investor on the planet has been overweight agency mortgages for quite some time. And now that we have seen an aggressive rally in spreads there on the back of GSE buying announcements, we're seeing more and more investors scratching their heads whether this is the right time to move away from agency mortgage overweights towards corporate credit. So there is a scenario where all that extra issuance gets absorbed, but quite a few things have to come into play.
Right, they all need to kind of fall in place. Danielle, I want to turn to leveraged loans. They're the main underperformer in credit this year, with tech debt down about 2%. So let's talk about CLOs, which hold mainly leveraged loans. What are you doing on CLOs? Since I believe at one point you told Bloomberg that you like the BB part of CLOs, which are more vulnerable to taking a hit than AAA.
Well, look, I think that the CLOs remain a better way to play the leveraged loan market, given the diversification you get in the collateral pool. The BB CLOs are still relatively loss remote, even with the weakness that we've seen in the tech sector these past few days. So I do think that this is kind of a classic tale of why adding diversification to your portfolio, whether it's through CLOs or other instruments, is going to be valuable in this type of market. So I do still like CLOs. I think it's one of the areas where you do get compensation for risk.
Right.
Spreads are still relatively wide. The investment grade market spreads are so tight right now. You know, you're still able to get at least 200 basis points or more excess spread in sub-investment grade liquid markets today, and more than that in the CLO market. So I do think you need compensation for the risk that you're taking, and you are getting that compensation in sub-IG today.
Very quickly, Danielle, on the distress side, are you taking advantage of what's happening here?
We absolutely are looking at opportunities. We're approaching this from a position of strength, being underweight the software and technology sector. So we do have the bandwidth to take on more exposure, and we are looking at liquid distressed opportunities, rescue financing, as always. And that's our DNA here at Oaktree.
Danielle Poli of Oaktree and Andrzej Skiba of RBC. Appreciate both of you joining us. And if you want more talk on credit, please check out the Bloomberg Credit Edge weekly podcast on the terminal and, of course, wherever you get your podcasts. Let's step outside the U.S. now for a check on global return, because in Europe, a nonstop stream of cash into the credit market has driven a gauge of risk to the lowest since the global financial crisis. For more on this, I want to welcome Helene Durand. She covers fixed income for Bloomberg News in London. So, Helene, tell us a little bit about what you're seeing in Europe and how much of this has to do with corporate balance sheets being a lot healthier than public balance sheets.
It's exactly that. Basically, you've seen deficits swell, across Europe, across the world. And on the opposite side of that, you've got corporate balance sheets that are in great shape. You've got some really well-rated companies out there, and for investors looking to put money to work, this is a great place to go, even though spreads are very, very tight.
Why hasn't Europe's credit market been affected by the rout in software stocks?
So it's interesting to, your earlier guess, actually, there's not that much sort of software exposed companies in Europe investment grade. It's a very, very small part of the market. Actually, big tech in general is a very, very small part of the index. And as a result, any kind of volatility that's happened in the equity market has not translated into credit spreads. And we hit this record tight this week. We've come off a little bit, but it's still very, very, there's barely any risk compensation, essentially.
And of course, when you're an investor, everything's relative. How does Europe look versus the US when it comes to credit?
Well, I guess it depends from what point of view you're looking at it. Actually, if you're a company, we've seen Pepsi and IBM, for example, come to the European market. Yields are lower here, spreads are tight. So actually, the funding conditions are very attractive for blue chips. And I think for investors, you've got this stability. And actually, what you've got in Europe is growth. We had German manufacturing data that came through this week that pointed to a sort of healthier economy, which should support these tight spreads going forward. I think people find it hard to kind of sell and see any reason as to why we should actually go a lot wider from here.
All right, Helene Durand, thank you so much for joining us. Helene joining us from London. Still ahead, a moment of interest. The New York-New Jersey River Tunnel project is now officially on hold after efforts to restore federal funding were unsuccessful. We've got more on that story in our Muni Moment next. This is Bloomberg Real Yield.
Happy Friday. We're halfway through the trading day in New York. I'm Norma Linda. Let's take a look at your midday movers. The Trump administration officials are discussing options for launching an antitrust investigation into U.S. homebuilders as part of the White House's effort to tackle the housing affordability crisis. According to people familiar with the discussions, the White House is considering directing the Department of Justice to open a probe into the industry. Shares of names like Lennar and D.R. Horton are both falling. Bitcoin is reclaiming almost all of its losses from Thursday's crypto market meltdown, which was the largest since the collapse of Sam Bankman-Fried's FTX exchange ruled the group more than 3 years ago. Bitcoin is rising as much as 13% today, rallying for its best day since 2023. Meanwhile, gold and silver are bouncing today after this week's slide. As geopolitical tensions continue to rise, investors are looking toward the precious metals as a potential safe haven. Those are your midday movers. I'm Norma Linda.
This is Bloomberg Real Yield. I'm Scarlett Fu. Now, a new Fed chair has major market implications, especially when it comes to municipals, and that is the subject of today's Muni Moment. President Trump's pick of Kevin Warsh led munis to outperform last week's U.S. Treasury weakness and reignited debate over the yield curve's trajectory. Joining us now is the head of municipal strategy and research for Bloomberg Intelligence, Matthew Casal. Matthew, great to see you.
Oh, it's great to be here on the show, and it's really a privilege. Thanks for having me.
So what specific implications does a new Fed chair present for munis? I mean, I get that it affects the overall macro environment, but what about the asset class specifically?
Yeah, sure. So there's much to discuss there, of course, and I would probably say in opening with kind of looking at the short end of the yield curve. Probably important to point out that once we first learned of the nomination of Kevin Warsh, we immediately started to see futures start to price in a lower terminal rate for Fed funds. And what's really interesting is that when you take a look at, let's say, the 2-year U.S. Treasury's relationship versus Fed funds currently of the upper range is actually trading higher, which to us, to be fair, that's kind of antithetical to more historical relationships and tells us that some of the rate reductions, of course, are already priced into the yield curve. Moving off of that, and let's just say taking one step further and going into munis. Munis are now in this period where we're basically experiencing an extremely constructive technical backdrop. We'll probably talk a little bit more about it later, but from my perspective, we have a little bit of a supply-demand imbalance in the market, which ultimately means that we have very low ratios. Munis are trading very rich to treasuries. So if we do continue to see almost like a bull steepening of the yield curve, short end comes down a little bit, mostly that means that treasuries have much more room to run until we start to see a response from municipals. Now, to be fair, I still think munis will probably follow suit just because the technicals are so strong. But it's important to stress that if we see that, That's price appreciation. And I'd probably say that versus other parts of the yield curve, it's probably not one of the sectors that you'd be most concerned with as far as Warsh is concerned, or the potential repercussions are just now. So.
How does this affect issuers? I mean, cities will have to issue when they need the money regardless, but how does it change their thinking, if at all?
Sure. So I would probably say that it's more of a notable concern when we're looking more on the intermediate to the longer parts of the yield curve. And almost contrary to what we're seeing on the front end of the curve, specifically with munis versus treasuries, munis are actually closer to the more long-term historical relationships on the long end of the curve. And what that basically means is that if we start to see any types of balance sheet reductions, right, or the thoughts, discussions of those possibilities, munis might be able to withstand that weakness a little bit more because of where the ratios are actually trading. Now, again, from an investor perspective, still need to be a little bit careful of the DV01s when you're talking about duration profiles that are that high. And of course, that affects issuers a bit more when those who are kind of focusing longer out in the curve.
Right.
The intermediate part of the curve, I think you have this confluence where suddenly you have low ratios, strength, and then the possibility for weakness. That's probably an area of caution that we're looking at right now.
All right, good stuff. Matthew, really thank you so much, and welcome to Bloomberg as well. Matthew just joined us after 25 years on the street, Morgan Stanley, JPMorgan. Matthew Gestal of Bloomberg Intelligence. Now, we're going to stay with our Muni moment because construction on the $16 billion tunnel to connect northern New Jersey with Midtown Manhattan, that has been put on pause. The Gateway Development Commission's CEO saying in a statement, the federal administration continues to withhold funding for this vital investment in our nation's rail infrastructure. With more now is Bloomberg's Michelle Kasky, who's been covering all of this for a while. So what's the next step, Michelle?
Yes, it looks like Gateway is saying at 5 p.m. today they will stop work if the funding doesn't come through. And they've been waiting on this money, and now they've reached the end of the line with their credit limits. And what's actually going on now, as it's going to start in just a few minutes, is there's a temporary restraining order. There's a hearing on that. New Jersey and New York State, they are both will be in court with the federal government to try to, again, get a judge to tell the federal government, you need to release this money and start sending it to Gateway.
This is federal funding. Is there any state money here?
There will be. There's of the project, there's about $4 billion. Now it's going to come through in federal loans, but New Jersey, New York, and also the Port Authority will need to repay that $4 billion.
Yeah, it's a pretty complicated relationship here. And once they stop work, and hopefully at some point, speaking on behalf of commuters in the New Jersey area, when they eventually restart it, because this is something that does need to be replaced, how much more expensive does this whole project become?
It's true. It does add up when you stop a project and have to restart it again. And again, the entire project is $16 billion. So this is a major infrastructure development. And Prendergast, head of Gateway, Tom Prendergast, he has said, look, you're going to be taking on costs that you weren't planning for if there's a stop and a restart. They need to securitize construction sites that are not abandoned, but will be on hold. They need to secure major heavy equipment. They'll need to move equipment around. It's going to be tough.
Yeah, it's a big project. All right. Bloomberg's Michelle Kasky, thank you for keeping us on top of all of this. That was our Muni moment. Still ahead, the final spread. The week ahead, the delayed January payrolls report, that is on deck. This is Bloomberg Real Yield. I'm Scarlett Fu, and this is Bloomberg Real Yield. It's time now for the final spread, the week ahead. Coming up on Sunday, you've got a snap election in Japan, and here in the U.S., the Super Bowl. On Monday, we'll get Fed speak from Governor Chris Waller and Atlanta Fed President Raphael Bostic. On Tuesday, earnings from Coca-Cola and U.S. retail sales for December and ADP employment data. On Wednesday, the delayed January jobs report comes out, along with results from McDonald's and inflation data out of China. On Thursday, Fed speak from Governor Stephen Miron and Dallas Fed President Lori Logan. And on Friday, the U.S. CPI data and Eurozone GDP come out, plus results from Moderna and CoreWeave. And for my final thought, we're looking ahead to the slightly delayed January jobs report that was delayed from today because of the partial government shutdown. And what we are anticipating is an increase of 70,000 jobs for the month of January, according to economists polled by Bloomberg. From New York, that does it from us.